for larger banks, I think SBA lending is just a step for them to bring a customer who's not ready for regular commercial loan into the fold, right? And then they'll try and put them into a commercial loan as soon as they can, and sometimes pay off the SBA loan where they make money. The bank makes money both on the premium and then because they'll sell these out to the marketplace, and then they can write that into a commercial loan. And I think that's generally what you see. But there are a handful of banks, ours being one of those, that really focuses on this as a core business. Because if you think of the total SBA volume that's produced each year, it's probably a rounding error for a bank like Citibank or what have you. For banks like ours, it can be very meaningful. And so we've got a very deep SBA program and SBA department, and we pride ourselves on fast turn times and being able to get the data together in a right way that helps the customer gather and understand what's happening. And so we're not always going back for more and more and more. And I think your strong SBA lenders focusing just more and more on that would probably be similar to this.
Cash flow? Cash flow? Did you clear your cash flow?
All right, today we got Kent Landvatter, CEO of FinWise Bank for the last 14 years. And you guys aren't just like a regular old bank. You guys have some interesting stuff going on, serving the fintech space. You know, you were telling me a little earlier about some of the API layer stuff that you guys do to enable fintech platforms and enable, financial technology businesses. So I'm really excited to dive into all that today, Kent. What if we just start? Could you just kind of give an overview maybe of yourself and also what you guys do at FinWise?
Yeah, absolutely. I'll make the history on myself short, but I do want to say one thing is back in probably late 90s, I got my first bank as president. And one of the things we developed there was a product where we would work with it. You know, at the time it was Sony Financial. We later did it with Dell Computers. But what we did was create a product where we were lending on those products, and then we turn around and sell that paper back to those companies. And we started thinking, and this was early 2000s, about how we could automate that. And we started thinking about, well, grabbing the data and using, the time SQL SQL servers, and then hard interfaces, which were difficult, to say the least at that time. But I've always been interested in the nexus of technology and banking, because banking is one of those industries that has a lot of manual labor and so forth involved with it. Historically, people would walk in, they deposit their checks and everything. And it just seemed with the advent of technology, there were a lot of ways to really make things operate more smoothly. And so I've been watching this space for a long time while I've been in traditional banking. So, just short history. My first bank was American Investment Financial by Leucadia. I opened a bank for Alliance Data Systems that is now Community Capital Bank and does credit cards. Following that, I opened Goldman Sachs Bank and presided over that for 4 years. And then I took this this was a struggling bank. It was called Utah Community Bank at the time, but I wanted to deploy this fintech strategy. And APIs were coming out and becoming useful and so forth. And so I thought, that original dream of being able to marry the data with the actual product and performance and so forth, to me, seemed it was the right time. And so this bank was in a little bit of trouble when I took over. It came from the Great Recession, but we got it recapitalized. We started an SBA lending program that is nationwide. We're one of the top lenders in the tri-state area, New York, New Jersey, Connecticut. And then we also Started a commercial leasing program, which is very active as well. Those are traditional banking products. We've got a branch and so forth. But 2016 was a very exciting year because that was the year we started to build the tech stack to support going into the fintech space. And we got our first partner signed up in 2016. And so it's kind of been an exciting journey for me from that initial nucleus of a thought of what would this look like, and to see it actually come to play in 2016 and further today. But it's been a fun journey.
Cool. That's awesome. And just for the non-finance people or the non-banker people listening, when you say selling paper, does that mean essentially selling the debt?
Yes.
Okay.
And so what would happen is we would originate a loan, and then we would hold it for a few days or hold it indefinitely. But then we'll eventually sell that loan to someone else. It's very similar to a mortgage. The person who writes your mortgage, underwrites it, and closes it with you, oftentimes will sell that to someone else.
Sure. Yeah, absolutely. And yeah, the SBA space, I actually just did an SBA loan for a partner buyout. I wish we would have met earlier. Would have, had a conversation with you guys. But last year I did a buyout, of my business partner at Curotech, and it's a great program. I mean, the SBA program, it's very intensive on the intake process, but certainly it's a great vehicle. I know a lot of people, a lot of younger people are using it to buy older generation businesses and
Mhm.
transfer wealth, and it's just such an incredible product. I'm curious, like I don't know if you can comment on this, but I'm curious, like with the current administration in office, is there any like risk or concern of the SBA program that you guys perceive, or
That's a really good question, and the short answer is no. Um, The thing that's been interesting to watch in SBA land, because I've been there for many, many years, is a lot of administrations will cut back on the subsidy or will increase the subsidy, to save money or to expand small business lending. But SBA, and I don't have the actual data, but SBA is one of the few government programs that I believe actually at least breaks even, if not makes money for the government, because when
oh, cool.
someone does an SBA loan, part of what they pay for that SBA loan is a fee that helps, support the subsidy. So the subsidy is really there as a backstop if too many loans go bad. But a lot of those fees are being paid by banks and customers that are participating in the program.
Well, the fees aren't small, so certainly,
Yeah.
I'm sure they're making some cash flow on that.
Right. So I'm hoping it doesn't, doesn't get hampered or anything, because when you think of SBA lending, you gave some perfect examples: transfer, generational wealth, all those types of things. But it's a real way for small businesses to perpetuate. And when you think of who the biggest employers are in the country, you know, in aggregate, it's the small businesses.
Absolutely. Yeah, that's really cool. Well, this is a tech podcast, so I really want to dig into what you guys are doing on that API layer stuff. It sounds really interesting, and I'd love if you have any, interesting use cases or case studies or anything that you can share. Something that FinWise has enabled for a fintech player. I'd love to kind of dive into some of that with you.
First off, you have to think of fintech um, in two ways. Banking is evolving, and you can't wind back the dial and not make it evolve anymore. I mean, you can't stuff this genie back in the bottle of all the innovation that's happening out there via fintechs. The other thing, though, is the volume, the sheer demand and volume and everything associated with fintech lending and the checking and all the banking services has to be automated. And so when we first got into this space in 2016, we looked around, and most of our peers, if not all of them, banking peers, what they would do is they would set the criteria that a fintech could lend under, and those basically are: what kind of credit do you want? How risky do you want to be? How safe do you want to be? And those are set in conjunction with the fintech, but it's really the bank's policy that sets that. And the traditional method would be, okay, let's approve these loans for the fintech, and then after the fact, after the loan's been funded, let's then take a sampling to make sure that the fintech is following all the credit rules that we agreed upon prior to the launch of the program. And to me, that seemed like first off, an area where you could really build in some economies of scale if you API'd that information into an enterprise data warehouse, but it also gives you certain controls over what's happening before the bank's money leaves to go to the fintech's customer. And so if you think of the old way of sampling, you've got to go back and say, oh, you shouldn't have funded one of these loans and you've got to get that money back. We built in a filter into the API so we connect directly to the fintech. They shoot everything through the API. It basically filters based on the model that we agreed, the credit underwriting model that we agreed upon, and says, okay, this is a loan that's worthy. This is the rate it should be priced at and everything. And it passes, it clears. And this is all instantaneous. And then it immediately goes to the batch funding and anything that doesn't meet that criteria is kicked out and then reviewed as an exception or what have you. The cool thing about that is we had built that in, and we noticed, for example, with one of our fintechs, everything one day just started rejecting. And they couldn't figure out why. And we went down and found out the rule that it was breaking. And they had made a change in their underwriting model where they had mistakenly combined two types of public record data points into combined them where they previously were separate, and they were approving on their side loans they wouldn't want to have approved. And it was our filter that caught that. And so, that's an immediate benefit for that fintech. And it also tells the regulators, we're not letting anything come through that hasn't been approved in accordance with the bank standards. So anyway, that's kind of a a real life example of how it created efficiencies, it created safety for both us and the fintech, and it was incredibly speedy. It immediately decisions or kicks out. So it was a nice piece, we think, and it's 100%, not a sample.
So your APIs are largely focused around the lending and underwriting process for a fintech. Let's say, I don't know, maybe you have specific examples, but like a Mercury or a Stripe might want to offer lending as a service to their users, and they can just go in and fill out forms, and that hits your APIs and goes through your underwriting process.
Right. So what would happen is it would go through the fintechs, and it would clear their criteria. Remember, ours isn't the fintech's model. Ours is what we've built is a filter that mirrors the fintech model to make certain that we're not trying to duplicate their model. We're just saying their model says it should be doing this, and it did this. And so it automatically goes to approval, and they're never then being faced with us coming back and saying, hey, you got to buy back X amount of loans because they didn't pass the test. And so it is an immediate feedback system. But you're right. The fintech customer would fill out the stuff. It would go through their model, then to our model, and then through the process to funding.
Does that only work with like more traditional commercial lending or like like invoice factoring or something, or would that work on something like an SBA process? Because I think with SBA you have to get involved with the actual SBA team, right, to get those approved.
Yeah, so that's a great question. We experimented and we watched others, experimenting with, is there a way to automate SBA loans? But you kind of hit the nail on the head when you said it's a very complex process, especially up front, and there's a lot of judgment used in what is needed to make sure you're hitting all the requirements of the SBA. And we found that the models on these types of commercial loans weren't really as predictive as we would like to have seen. And so we never really jumped into that space from what we were looking at. It doesn't mean it can't be done, but there's just a lot of judgment when you're looking at the documents that can, especially if you're talking the multi-million dollar loans, it could get a bank into trouble if they weren't real careful at looking at those.
Yeah, and that's what mine was, and it was just a lot of PDFs back and forth, and
Uh-huh.
I won't say the bank's name, but they sent me a PDF template, and there was like someone else's info on there, and I'm like, man, this I was like
Oh.
this can't be like the best way to do this.
Yeah, there are better ways, but I think there will be, especially for smaller dollar loans, there may be opportunities. Um, we didn't find that the predictive nature of the modeling um, really satisfied our risk appetite.
To automate it, you mean?
Yes.
Yeah, makes sense. Is that like a big market for banks, like these SBA things, or is it more like is the commercial lending side like more interesting to a bank typically?
For larger banks, I think SBA lending is just a step for them to bring a customer who's not ready for a regular commercial loan into the fold, right? And then they'll try and put them into a commercial loan as soon as they can, and sometimes pay off the SBA loan where they make money. The bank makes money both on the premium, and then
Yeah,
because they'll sell these out to the marketplace, and then they can write that into a commercial loan. And I think that's generally what you see. But there are a handful of banks, one of ours being one of those, that really focuses on this as a core business. Because if you think of the total SBA volume that's produced each year, it's probably a rounding error for a bank like Citibank or what have you. For banks like ours, it can be very meaningful. And so we've got a very deep SBA program and SBA department. And we pride ourselves on fast turn times and being able to uh, get the data together in a right way that helps the customer gather and understand what's happening. And so we're not always going back for more and more and more. And I think your strong SBA lenders focusing just more and more on that would probably be similar to this.
yeah, and I think you might have more insight on this, but I think it obviously the commercial lending terms typically are a little better than the SBA lending terms, but then you have like covenants and stuff that you have to meet typically on the commercial side, whereas the SBA doesn't. And I think what I understand is, it makes sense to look at commercial when you either have a strong collateral position that you can offer the bank, or if you have, I don't like, I have a professional services firm, so there's like no collateral other than cash and AR. So I think what made sense there was to have like at least a few million in EBITDA to really
Mhm.
take the commercial side more seriously.
Yeah, I think that the collateral um, is always an important part of traditional commercial lending, and then they will absolutely look at the enterprise value. If you've got a great piece of collateral, but you're losing money every month, they're probably not, no one's probably, except no bank is probably going to take that credit. They're going to look at the enterprise value as well as the collateral. But there are things such as lines of credit, working capital lines of credit, and so forth that, I think the stronger the company, the less collateral generally would be required. But that's not really our focus. We focus on the SBA customer specifically. We also focus on smaller working capital commercial loans through some of our fintechs. But, it's just that's a big bank model, and we're certainly not a big bank. But
Yeah,
it's
for sure. Yeah, you brought up FDIC. I've seen like I mentioned Mercury earlier. I've seen they do like some sort of like load balancing or something across multiple accounts where they sort of like give you a higher FDIC up to 5 million or something like that. Does
Mhm.
that work? Like,
Oh
is
yeah.
that legit or?
Yeah, that is legit. And so what happens, that's called reciprocal deposits or whatever. But there are a few companies that are will take, like, if I'm a small bank and I have a commercial customer that says I want to put $5 million, but you only in your bank. I love you guys, whatever, but you only go up to 250, and I trust you maybe to 1 million, but not to 5 million. What that bank can do is it can go to these sweep markets or reciprocal markets, and basically what you're doing, it's an exchange where you're throwing your 5 million excess over the insurance, into this pool, and the company that runs that pool distributes $250,000 pieces of that outside. And those are callable back, based on whatever contract you have, if the customer needs to get the money. But then what would happen is you would want the benefit of having that $5 million. So they'll send you $250,000 pieces of other banks that have thrown their money into that. And so it's a pretty recognized business, but it's basically an exchange where they're finding banks interested in taking the 250 limits, and banks wanting to, sell their deposits into that and bring.
Oh, interesting.
Yeah.
Doesn't I mean, why is the FDIC set to 250,000? Like, and if there's a reason for it, like wouldn't this kind of be like gaming the system in a way?
You know, uh, that's a huge discussion right now, and has been for several years. I think it was during the Great Recession that they just raised the insurance from 100,000 to 250,
Oh,
but
wow.
100,000 was probably set back in 1950s or 60s. I don't know when. And 250, they've not kept pace with time, and so a lot of the proposals to Congress have been, can we change this so it moves along with time? So $100,000 in 1955 money certainly isn't worth 100,000, or it's certainly not giving you the full value today. It's worth maybe 5, 10,000 today. And so, it's just, those are ongoing conversations at Congress and so forth. But I think the bankers community would like to see that raised commensurate with inflation and, just those types of things.
So it's just one of those things. It's just like inertia in the government. It's like to get that bill passed, like both sides would have to pepper in like 50 other things to agree on
Yeah,
it. And
right, right. Yeah, I mean, it seems so common sense to me, but it just never got any wheels, but it's always up there bouncing around.
I mean, I guess if they're letting banks and financial institutions do this kind of like whatever you called it, like this kind of sprinkling across multiple accounts, I guess they recognize that it's a problem, and they're okay with it, you know, technically being hired through these like sort of back office means.
Well, yeah, and if you think about it, what the FDIC is, they're a regulator, of course, but they're an insurance fund. And the banks, not the government, but the banks are the ones who pay into that fund, right? And so when banks fail, it's not the government that bails them out, it's other banks. And so what the government's role in this is if the banks pay in all these premiums, it's been like 1.2, it's usually been 1.2 for 5% of total assets. It moves up and down, but the FDIC wants 1.25% in of the total assets in this fund. And if a whole bunch of banks fail, like happened during the Great Recession, and that fund dips way low, then what the FDIC may do, and I think did at least during the Great Recession, is they borrowed against the Treasury until the banks brought that back up. But the federal government, I don't know if it's ever lost any money on a bank failure. It's always the banks. And so banks are pretty careful. They want to make certain that they're doing things right because we're ultimately paying the premium. And I think the FDIC recognizing that there's perhaps, this is me jumping in their mind, and I'm not sure exactly how they think, but imagine what they think is, if sprinkling these $250,000 deposits creates a feeling of security for the depositors throughout the system, that's better than a single, like a company saying, I've got 5 million and I don't want 250 with any more than one bank. So I've got to do all the work to get it out. And I think, if you look at it that way, there's a sense of security in the system by allowing more of the deposits to be insured.
Yeah, it's pretty crazy. Like when you say it like that, it is like the whole financial system is just kind of like group psychology and hey, when you really think about it.
Yeah, that's actually that's good. If you think of the stock market, it's not too much different. You'll
Yeah.
see trends and so forth based on technicals of buying and selling. It's interesting stuff, I think.
I never really thought about it like that until all of like the kind of white papers around crypto started getting popular in the mid 2000s. And,
Uh-huh.
then you start looking at like historical things, like the thing everyone references is the tulip craze thing that happened back in Holland's,
Yep.
a couple hundred years ago or whatever. But, yeah, I'm curious, like what, just from a bank CEO perspective, what do you guys think about crypto? And is that like, is it something that, banks are interested in and excited about, or is it something that's, kind of like weird or like a risk, or how do you see it?
I think let me separate crypto from things like stablecoin, right? So crypto, or at least make a distinction, I should be say between um
I mean, you've got like,
speculative,
Bitcoin, which is like the standard. You've got Ethereum and Solana, which are like
right?
programming layers. You've got the stable coins, and then you've got all these like trash meme coins that come out every week.
Right, right. So what I would actually say on that, and this is just my view, I think all banks have different views on this, but I'm not as interested in the side of crypto that's more speculative. If you look at Bitcoin, that's a speculative thing. And I got to say, I was scared of that 20 years ago, and I kicked myself for being scared of it, because it's a great speculative tool and has consistently returned value, even though it's pretty volatile at times. But stablecoin is a way of moving money. And if banks aren't thinking about stable coin, they probably should be, because basically settlement transaction, moving money, that's one of the primary businesses of a bank. And so, when we have just rolled out our money movement rails, or we call it money rails, but it's kind of a payment hub. And we think about stablecoin and how that would move across that as well. And so it really, as far as transacting business and settling and so forth, I think banks probably should be looking at it very seriously. As far as Bitcoin and the more speculative currencies, I would say, that's up to each bank's own risk appetite, but it's probably not in ours right now.
It does seem like really crazy. Like some of the bank infrastructure, like, just not even like any one individual bank, but just like the way the global financial system works, like all these big like payment rails for like, Visa and MasterCard and, all these things like like ACHs and, wire transfers. You've got like sometimes if you're doing international wire transfers, you could have like one or two intermediary bank hops in
Uh,
between. And it's like, it does seem kind of crazy, like at this point in time.
it does, and if you look at stablecoin, I'll keep using that as a term, just to be clear on, the distinction between that and more speculative
A
means
stable
of
coin just pegs to the US dollar, right? That's
yes, or some kind of a fiat, or could be gold, or what have you, but it pegs its value on something. So it's not too dissimilar from a dollar bill, that used to peg itself on gold and then silver and then, just the faith of the federal government. But it's pegged to something, and so the value doesn't go up and down. And so if I buy something from a merchant, the merchant's going to get that value just as if it were a dollar, versus, if you transacted in Bitcoin or just like any foreign currency, you have the vagaries of what's happening to that foreign currency vis-a-vis what I just sent out, right? And so that's probably the way I would look at it. We're looking for a stable coin as something that a value is a value. It's tied to an asset or what have you that doesn't move in value.
Are stable coins like truly stable, like their promise says? I've heard, I don't know, like Terra Luna or whatever, that one had like a big blow up a few years ago. But there's like, from what I don't know a lot, I'm not super knowledgeable on how stable coins work behind the scenes, but I understand there's like all these sort of like balancing trades that happen on the back end to keep the stable coin stable and pegged. Uh, like liquidity, I guess they do like kind of two-sided liquidity or something to kind of keep the value pegged.
Yeah, I think, rather than go back and look at that, I think what we're looking for, and I think what the government is focused on right now, this new administration, is trying to define exactly what that is. Because to me, stablecoin, you could say I've pegged it to the price of anything, and so it's therefore stable. But if you pegged it to the price of a commodity, commodities change, commodity prices change. And so if I pegged it to a fiat currency like a dollar or what have you, then the only it has to be backed by those dollars. And
But
so
even currency though, like my wife does forex, and like even though even currency, even fiats will fluctuate
yeah,
all the time.
yeah.
So everything in relation to everything fluctuates all the time. The interesting thing I've heard about what you're talking about, the stable coin thing, is like if stable coins become a standard payment rail,
Hmm.
uh, and they're pegged to the dollar, that further uh, cements global dollarization. Uh,
I've heard that too, and oh, I don't know if I mean I just wonder if that's part of this whole thing is why there's a renewed focus on it is to keep the dollar the global currency, but that's probably not yeah, that's just what I think about sometimes, but I haven't heard anything really other than speculation.
yeah, yeah, interesting. I mean, what other currency would if the dollar was not the global standard? What else would be? I mean, like
Yeah.
euro or something, or
Well, the thing I always think of is it's a relative value and that people are looking at. And when you look at, they say the full faith of on backing of the federal government, the U.S. federal government, that's even though you're seeing, huge deficits and things like that when compared to other countries, that's something that still is relatively safer in people's minds. So I think it's a multifaceted issue, I think.
my wife and I went to Argentina over the holidays, and
Uh-huh.
that they've got insane inflation. It's like I
Is
was
it?
looking at I was there. It's 1,000. It's over 1,000 to 1. It's like 1,100 to 1. The Argentinian peso to the U.S. dollar. And I
Wow.
was looking at the chart over history, and it's like if you go back to even like the mid 2000s, it was like 30 to 1 or something, or 40 to 1. I don't remember the exact numbers, but it was like a fraction of where it is today. And if you just look
Wow.
at like the last couple of years, like the last 2, 3, 4 years, it's just like a hockey stick.
Yeah. That's
Inflation.
crazy. That's crazy. Yeah. So I think, dollar, I'm way above my pay grade here, but, dollar, being the global currency and US debt being the global debt, I think has a lot to do with relative value.
I want to take a quick break from the episode and say if you're enjoying this content, the best way you can say thank you is to subscribe. So if you're on YouTube, hit the subscribe button and the notification bell. And if you're on one of the podcast platforms, hit the subscribe button there as well. And also share it out to your friends and colleagues. If you find this content useful and you think other people will enjoy it as well, please send it out. And back to the episode. Well, let's go back.
Okay.
We didn't touch on the API stuff all the way. I'd love to
Right.
circle back to that. So you started to kind of talk about like the lending process and matching the fintech's underwriting process to your underwriting process, and there's two checkpoints to
Mhm.
make sure that the debt is good debt and underwrites properly. Do you have any, like big names or any like interesting use cases where you've implemented like a case study that you could share or something that where you've implemented your technology at a fintech and how it's being used today in the, in the market?
We actually don't. The Right now, the fintechs that are looking for bank sponsors, I think they're looking for banks that haven't gotten in trouble with the regulators. And we've been doing this for over 8 years now. And so, we've been through several regulatory exam cycles, and they know us and we know them. And I think what a fintech is looking for more and more uh, is they understand the value of the bank conceptually, but it's almost an existential question for fintechs if they align themselves with the wrong bank. For example, if they sign up with a bank that is going to be closed down or put under a cease and desist, it could impact their business model pretty severely. And so, what I think fintechs are doing, rather than looking for the use, they're looking for how to get their product through their banking type products through the system, so they can offer their customers embedded banking or finance or what have you. And so a bank that knows how to do that, we look at ourselves kind of as building the plumbing behind the scenes and handling all the risk oversight behind the scenes and the compliance behind the scenes. But the customer or the fintech has got to be thinking, if we mess up, what happens to us, the fintech? And so I think what we're seeing, and I think others that have gotten through the last few years without being scathed by any regulatory orders, is we're seeing more mature fintechs come to us just by virtue of, we feel more comfortable that our business model is sound when using you in the background. In fact, we even recommend to fintechs that can afford it to go with banks other than ourselves, because that you always want to avoid a single point of failure. And so if I'm a fintech, I'd probably stand up to, and had the wherewithal to do it, I'd stand up to banking relationships. And, just in case it's an insurance policy, if you will.
Yeah, I was going to ask about that. Like I've seen that in e-commerce as well, where it's like you'll have a couple payment processors. So if one
Mhm.
goes down or if one starts rejecting, payments, you can sort of like flip between them, and you can even like write that into your code so it just
Yeah.
automatically happens. That's
Yeah.
interesting. Do you? Just to clarify, are you able to talk about any examples, like any of the fintechs that use your infrastructure? Are you able to talk about like any specifics and what they're building?
We can't really, excuse me, can't really speak about the fintechs that are in our pipeline and some of the things that we're building for them. But we have signed some fintechs, and just recently in the fourth quarter we signed one that actually will be using some of our new products in conjunction with the lending as a service. So if you think of what a fintech um, really wants to be, is everything they can to their customer, get as much of the wallet as they can. And if you're only giving the loan, but you can't give them a card, or you can't give them savings, or the ability to pay bills or what have you through that fintech, then they're only taking a piece of that pie. And so what we did, we started out in the lending as a service space, but about a year and a half ago, we started building out card sponsorship models where, we can do push to debit, prepaids, credit charge, those type of things. But then we also built something that I think is fairly unique right now in the industry, and we call it money rails. And it's a way to move money. So a lot of the fintechs today will go to one bank for their ACH and wire movement of money. They'll go to another bank to move things on FedNow, or another bank to push things through Visa Direct, or one of the card platforms. And so what we thought is, what if you built a payments hub that had all the rails built into it? And that's why I say stablecoin is something we think about when there's more clarity around that being maybe one of those rails. That it basically has all these rails built out in one centralized location then we have developed an API that we can give um, to the fintech now that's customizable by the fintech. And so maybe a use case there that I think people are finding interesting. This is just one of a few, but let's say the fintech is concerned about getting the money on a loan out in a certain period of time. And as you get later and later in the day and get closer to Fed cutoffs or whatever, you say, okay, I've got to go ACH until maybe 2 p.m. Pacific time, and then I've got to figure out whether to wire the money, which is really expensive, or I've got to go to my other bank to see if I can push it to a card or what have you. But if we build an API that's customizable by the fintech, where they can go in and optimize all that, they can say, if it's up to this time and the customer wants it this fast, use these rails. And they can optimize the use of the rails because it's all on our system. And so they can push the money or receive the money any way they want, but push the money which is optimal for the customer and at the least cost for the fintech. And then when you add that to the lending side, receiving payments and so forth, it really gives a fintech a lot more options of one-stop shopping on the movement of the money in support of their customers.
Interesting. And it's like when they're building out software on top of that, on top of those rails, do they choose which rails they want to use? Or would it be like in the future, could it be a situation where it's just like, hey, this customer wants to move money from this account over to this account, and they just send you that information, and then you just on the back end, like FinWise could just take that request and say, all right, we're going to find the best rails for this transaction at this time, what's going to get there the fastest and the lowest fees, and just kind of make it
Yeah.
happen.
Yeah, well, for example, we can build smart contracts into the movement of the money as well. If this happens, then that. If not, then this. And you can build in these types of, if this settles, then move the money. If it doesn't, then don't. And so we can build that with the fintech into the API today. And so how much they want to do or how much they want us to do, we can, is the negotiation. The one other thing that we built into this, though, if you look at a lot of the banks that have gotten into trouble, the two primary drivers have been BSA, which is anti-money laundering world, right? And then the ledgering. How do I know if I'm a customer that's put money into this fintech? How do I know, even though they say it's FDI insured, C insured, how do I know it is? And how do I know that's sitting at a bank? And so generally the fintech will build out a ledger where they can track that, and then the banks, and we do this as well, would look in and do a daily reconciliation and make sure that everything they say that is FinWise is here, and the customer always has access to it. But we've also built into our money rails a transaction ledger as well, which be a full ledgering system, which, if they want to use ours, we can tell them exactly to the penny where that money is, tell the customer where that money is, if it's in some holding account, or if it's here at the bank, sitting and doing what it's supposed to be doing. And so we've tried to solve both of those problems, the BSA, where it looks at everything end to end, because we have full line of sight, and then the transaction ledgering to make sure that everything is where it's supposed to be when it's supposed to be.
Interesting. I'm not super knowledgeable in the depths of the banking world, but that sounds pretty advanced to me for the average bank. It sounds like you guys are kind of pretty cutting edge with your technology. Is that an accurate assessment?
Um, I, I, I'm not sure exactly what other banks have, but I don't know of another bank that has this. I'm sure maybe some of the big money center banks do, and so forth, but I haven't heard a bank in the BaaS space, banking as a service base, that I haven't heard of a bank that has this, but I think banks will follow.
Interesting.
But I think we're unique in this.
What are your guys at FinWise? What's your vision? Do you see yourself kind of like eating this market over time and becoming the de facto standard, or do you like kind of being more of like a small technology enabled boutique bank, or and I don't know if that's an accurate description, but
Yeah, so there are a couple of things that have happened over the last few years when um, regulations were not as tight around best banks and regulators didn't fully understand it. A lot of banks jumped into it for various reasons. You look at the margins. Oh, I can make some good money here. I can get some low cost deposits in to fund my other businesses. But it's an extremely difficult business to enter into well, as a lot of those banks found out. They got cease and desist orders, and they've either exited the space or substantially slowed down until they build it out. But
is
it
that from
takes
the SEC would send those out, or who sent
yes,
those? Okay.
yeah, the FDIC would. They have the FDIC has a public um, they have different varying ways of putting a bank under an obligation to clean things up or to do things right. But the worst of those is usually a public order, which is now in the public site. And those are, in the form of consent orders or cease and desists. And if you go through the banks that have offered banking as a service products over the last 2 years, you'll find 20, 30 banks that have got consent orders. And when you think there are probably 50 banks in the space, that are really focused on it, to see that many fall out so quickly, is pretty dramatic. And that's why I think you're seeing fintechs. We call it a flight to quality, but they're rushing to those banks that have made it through all of this and they know can do it well. So that's a backstory on, I think, this marketplace right now is hard to get into because, for example, almost 40% of our staff is focused just on monitoring the risks around our third-party relationships, IT, um, CRA, which is community reinvestment. We've got compliance. We've got uh, um, monitoring and testing. And we've got almost 40% of the staff of our bank just focused on those things day in and day out.
Wow.
And when you think of that for a small bank like ours, maybe 75, 80 people just focused on that and nothing else. For another bank to get into it, you've got to hire 75 or 80 people, and they all have to be really good, that, certified in their fields and really know what they're doing because this is a complex business. And so the moat to entry is not insurmountable, but it is hard, because banks get into trouble if they don't do it right. So the way I see this evolving is banking is changing. And, I look at myself, an old guy, that we have a branch and that I'll go into there occasionally. But the last time I went into a branch to transact business was probably 25 years ago. And so when I think of, just me being a traditional old guy that, would stand in line on Friday and deposit his paycheck and those type of things, not being in a branch for that many years, there's a sea change going on. And I think there'll always be a space for, your community banks and so forth. But money is being moved at 2 a.m. in the morning by someone who gets up and pays someone. Venmo is being done, as someone finishes eating and says, I'll Venmo you my side of the bill. I mean, that's happening any time of day, every day. And it's just the world's changing, and what we want to be is um, in that wave of change, where we're taking advantage of some of the sea change that's happening. As far as size goes, we can't be over 10 billion or we lose our ability to transact as sufficiently on credit card space. And so most banks in this space will try and keep under 10 billion, which is small in banking standards. Um, but for us, I kind of like what you said. I'd like being the innovative, tech-enabled side of this that makes life easier, creates good profit for us, and I don't have to be the biggest guy in the planet. We know who we are, and we'll play in that space.
That's really cool. And I'm learning so much talking to you, Kent. There's like so much nuance to this banking world that just doesn't it's not like natural or intuitive, I guess, if you're not in the space.
Mhm.
And you brought up regulation a lot on this call. I think we talked about FDIC. I know we talked about SEC on our last call, and I'm curious. Like, it sounds like that's kind of a moat for you guys. From what you just described, that you figured out how to navigate these regulator bodies and kind of exist cohesively in a way that they're comfortable with, which I guess makes it harder for competitors to come into your space, which is great. I'm sure that goes on the strengths part of your
Yeah.
SWOT
Uh-huh.
analysis. What do you how do you find like working with these like regulation bodies? Is it like extremely challenging? Do you feel like they slow down innovation, or obviously they're trying to protect consumers and all that, protect depositors, but how do you find working with these bodies?
Um, you hear a lot of people complaining and so forth, but honestly, we've got a very collaborative relationship with them. But I think it's based on building a level of trust. They know that first off, I never want to surprise them. If there's something that I'm thinking about before jumping into it, I'll say, hey, this is what we're thinking about. This is how we're going to approach it. Here's how we're going to manage the risk. You're going to see some anomalous spikes in this or changes in that, and we'll keep you posted throughout that. And to me, it's kind of a building trust by mutual respect, right? You tell them what you're going to do. You tell them when it went right, when it went wrong, and what you did to retool. And over the years, you're able to develop a relationship that I think is really a powerful relationship in helping us as well as helping the ultimate customer, be safe, to help the banking system be safe, to avoid money laundering. Those are all good things. One thing that I think we find not as directly, but I think indirectly nationwide is, I'll call it the tone at the top. And if the chief regulators do not like the innovative aspect of banking, then you will find tone at the top pushing down this try and find this or really look hard at this. And it gets to more of if this little checkbox isn't checked, then let's make a bigger deal out of it. But that hasn't really floated to us. It has a little bit from time to time, but we just try and do it right. Regulators know we try and do it right. If we miss something, we'll correct it quickly because it's complex. You're always going to miss something, but your systems of identifying when you're missing things and correcting them and then communicating that are important. And that's what we built out. And it takes a lot of time to stand something like that up with the regulators. But no, I haven't found them challenging. I've found them actually collaborative.
Cool. My experience, I mean, I have a small business, so my experience dealing with, government bodies is just setting up LLCs and paying
Uh-huh.
taxes. And it's like you mail stuff in and you mail forms in and, you get a form back in the mail. But I imagine at the level of scale and sophistication you guys are at, are you like going out, like flying out to their office and sitting down in a boardroom and talking through your ideas and, kind of getting feedback in real time in that way?
Yeah, actually, you're hitting the core of it, Brian, is it's just that uber communication. And so what we used to do when I first took over the bank 14 years ago, it was under a cease and desist and was about out of money and so forth. And I was able to recapitalize it. But when I started talking to the regulators about this is how I want to take the bank, it took a lot of meetings, and we flew to our region in San Francisco. We talked to our local people here in Utah, and made certain they understood that there were um, guardrails along what we were trying to do, and there were fail-safe systems, and that we had enough capital to jump into these spaces. And every quarter, banks file what's called a call report. It's a public document with all their financial information. And, I'll always call the regulators if there's something a little strange, like a tick up in delinquency, or all of a sudden our liquidity had a big, huge pop or something like that. I always call them and explain this is what happened and this is why. And it's just so they're never caught by surprise. But it's at least annually, we'll meet face to face with all of our regulators to tell them where we're heading for the next 3 years. And these are, same kind of process. This is what we think will be. These are some of the governing factors, and we'll let you know how it goes as we continue.
Cool. I really appreciate you letting me grill you with all these questions, Kent, and
No
just like
problem. This
give
is
me a window into your world.
no problem.
Is there anything that you were hoping to talk about today that we didn't hit on?
The one thing that you talked about earlier was AI and our use of AI. And the AI, I think, is still in its in generative AI, I should say. I mean, people have been using forms of AI or machine learning for years, right? But you know, s- we are being careful about it. We're not like a traditional bank where you'd get a lot of AI pop from maybe marketing strategies and identifying, customers to cross sell to, those types of things. Our AI would be more on the risk side. For example, in our money rail system, fraud detection and things like that. We would be building. We would have AI functions there. Um, I think AI right now has a lot of promise. I think that the use case for AI should be carefully thought about. And the one wrinkle for banks is when you think of your large language type of models on the AI, that's usually going out to public domains. And then you have your closed loops. Well, a bank can't really go out to generative large language model places where there's any kind of proprietary data that goes out there. If we wanted to say, okay, we want to write a letter to all of our customers who have this kind of transaction and da 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 da. All of a sudden, that's in the public domain, and we've got to be really, really careful about those types of things. So there would be closed loop models that we would use and do use. The For us anyway, the large language might be used in things like scraping federal regulations, state regulations, and comparing them to our policies and procedures, and seeing if there are gaps or what have you. But just I wanted to answer that because I think it's an interesting question. We're looking at exactly what we do right now. We're right in the middle of that process of saying, how do we utilize that at FinWise? So anyway,
Yeah, for sure. We do the same thing at Tech. We've got obviously we use LLMs from OpenAI and Anthropic for generating code.
yeah,
But we do have some clients that are concerned about the same thing you just raised about, not having a LLM where you're sending data to another company that, we don't know what they're going to do with it exactly or how they're going to protect it.
right. Mm-hmm.
So we've actually spun up our own LLMs on GCP infrastructure where our developers use what's called an IDE. It's an integrated development environment. Basically, it's where you write code.
Uh-huh.
And the new IDEs all have AI features in them to be able to generate code quickly. So you can write software like 3 times or 5 times faster.
We
So
actually use that piece as well here for our developers. They use that as well. I'm not sure if that's I can't remember. Oh,
Cursor or Windsurf or something or
I
GitHub Copilot.
We do have Copilot. But they use another. I can't think of who it is right now, but they use another company for the assistance in code to make certain it's solid sound, all those types of things, right? So
Yeah, it's pretty
it's,
wild. I mean, you guys are more advanced than a lot of companies if you're doing that, but it's pretty wild how it's going. I'm actually going to be doing a talk at Laracon this year. It's the conference for the framework Laravel.
uh-huh.
It's in Denver in July, and I'm going to do a short talk about AI, how it's a horizontal enablement layer. So a lot of developers, especially developers that haven't fully adopted AI in their toolkit yet, are afraid that like, oh, well, this is, they're thinking about their job as it is today and as it has been for the last decade, and they're thinking like, oh, well, AI is just eventually going to automate my job as a developer and I won't have a job.
Uh-huh.
But if you think about AI as a horizontal enablement layer, and think about what other horizontal enablement layers have there been in technology advancement. The last one was cloud computing. Before that was the internet. Before that was telecom and like ISP networks. And before that was semiconductors and transistors. And before that was electricity. And each one builds on top of the other. And if you think about it, like look at electricity. Before electricity, the energy industry was coal and kerosene and whale oil and
Uh-huh.
stuff like that. And so when you think about what electricity enabled, it enabled Henry Ford to build the assembly line. It
Right.
enabled
Uh-huh.
Otis to make elevators, and then now we can build skyscrapers because it's
Yeah.
practical to live in a 30-story building now. And it enabled X-rays, which advanced medical technology
Yeah.
and medicine. So like electricity enabled all those things, and so did the internet. The internet enabled all sorts of other things, and eventually the internet enabled AI, which is where we are today. And AI will enable all sorts of new things
So,
that we don't even
yeah.
know about today. So it's like if you think about it from that context, not what we have been doing for the last 10 years, but what can we do for the next 20 years?
Yeah.
It's a
I
whole
think
new frame to think about it.
that's a really cool perspective. I've actually used more of a negative one now that I'm thinking of it. Just I've always kind of said, just because we don't adopt it doesn't mean no one else will either. I mean, you're never static. You're either falling behind or staying ahead. But yours is a much more positive message. Is this is a huge opportunity, and you just build off the shoulders of those who came before you. And build.
Yeah, exactly. And the key thing, like the key like shift that, the key shift I've made mentally is like it's not about like getting better or faster at exactly what we've been doing because it's we can do that, sure, and maybe we'll automate some of the stuff that we have been doing, but it's really about like what are all the new things that we could do in the future, like the new opportunities that weren't feasible or practical before.
Uh-huh.
Like what are all those new things? And it's like,
Yeah.
you can't possibly like when electricity was, I think it was like the 1880s was the first commercial generation plant in New York City for
Uh,
electricity. You couldn't possibly predict X-rays. You couldn't
yeah.
possibly predict, like skyscrapers. Like that stuff just wasn't it did like connecting the dots, like you have to go so
Uh-huh.
many layers to get to those advancements. It's like you can't really connect the dots. Like when you see the enablement, like the technology as an enablement layer, you
Mhm.
can't predict what's going to come
Uh,
out of that.
well, you look at your phone and what it does today versus I mean, when I grew up in the 60s and 70s, you know, I loved music and I had these vinyl. I've gone back to vinyl on a lot of stuff, but I had vinyl and then we went to cassette tapes and I think, God, I can in a cassette box I can have the 8 albums versus the vinyl, and to think that I can have thousands and thousands of songs, tons of movies on this screen that's not a cathode ray tube, and it's amazing. But the ability to transact and evolve in banking comes from these devices too. And so, one thing you can't really tell the impact of something until, looking backwards and seeing it. It's amazing to me.
Yeah, 100%. Ken, do you want to do like a quick plug for FinWise before we wrap up here?
Oh yeah. Yeah, thank you. We've been doing the fintech banking for over 8 years now. We build out systems that have been proven to um, safely support our fintechs. We are very fintech focused to make certain that their success is our success. And we may not be the easiest to stand up a product with because we take the regulation and the control environment seriously, but once it's stood up, we feel really confident that the fintechs are going to have a safe place to reside.
Awesome. Yeah, check out FinWise online. Ken, thanks for coming on. I really appreciate you.
Thank you, Brian.
Cash flow? Did you clear your cash flow?